a big hand to Axel and Henrik from ArK Kapital. Okay. This is where I need a couple of seconds to settle in. So that I don't. Okay, so really happy that you could join us today, and really happy that you could join us as a group. So like, I thought it'll be interesting knowing two different perspectives on how ArK Kapital has been developing and how you guys are going forward. But before that, a little bit about your background. Why ArK Kapital? How did it start? How did you meet as a team? If we can go there and start.
You start.
Right. So I have a pretty different founder background. I started out as a consultant and then worked a long time in a Nordic bank, Nordea. And sort of while doing that, I got sort of more and more interested in the whole startup community. So I've tried my hands a little bit in investing and starting things up, but didn't sort of fully commit. Instead, I started to trying to mold my Nordea role towards helping to finance startups, and ended up building out a sort of startup financing brand of Nordea called Startup and Growth. And what we realized there was the startup, sort of the whole banking world wasn't really catered to startups. I'm sure a lot of other entrepreneurs have experienced the same thing. We found that there was a sub-segment of startups that actually fit what banks were looking for, that had stable revenues, strong gross margins. And then we managed to squeeze quite a few of those into a mold and lend money to them from Nordea. Of course, what you can do in a big regulated bank is quite limited. And I felt that, but we were on to something. I felt we needed to do it on a significantly larger scale. So started thinking about how to do that. Met our third co-founder, Oliver, who also had a lot of ideas around that. And then we really got thinking about sort of partly how to push the cred model, but we also realized we needed a significantly deeper sort of data angle than anyone was really using. And then started looking for someone like Henrik.
Exactly.
Okay.
And on my side, in my universe, I was having a slightly different background. I started coding when I was young, worked as a developer in the golden.com era, which was super fun. But I was also interested, I realized, in the business side. So I went to school and then to McKinsey to like understand more how business is being run. And after 3 years of doing like the McKinsey school, I felt I really want to get back to tech now. So then I got the opportunity to join Spotify in 2010. And very early on, I got the task to build the analytics team there. And at that time, the whole technology that allowed us to store every click of every user was brand new. So we had great developers at Spotify back then, and still are. So we could use that technology early on. So we could build that analytics team in that new world where you have all that data available, which completely changed how we could like do analysis and make decisions and grow faster as a company. So like how do you leverage the fact that you actually know every single click of every single user when you're about to make a decision about what product to build next, which marketing campaign to do next, and so forth. So we were early on like figuring that whole thing out, first technology-wise, but then like business-wise. So after doing that for 5.5 years at Spotify, I felt this is how every industry will transform. So then I left Spotify to build a ventures fund, Equity Ventures, in Stockholm here. And even there, we wanted to build a big European fund, which was very data-driven, using that knowledge. So we did that, and I was part of setting that up, and we invested in probably around 100 companies, I think. And every company we invested in, I tried to help them to work in this data-driven way of growing their businesses. And then after doing that for many years, I felt founders, there is not this platform that I always try to coach the founders that they should have to grow faster, that we had at Spotify, is what every founder should need. So I thought this is something that someone should build. And the other was the financing side. So it was great to be VC, to be able to invest 10 million euros in a founding team. That's amazing, and to see what they can do with that. But I also realized that the VC mandate is super narrow. Most founders, they don't fit, and they don't want to, and they probably should not go for VC. because it requires lots of different things, and most founders are not really suited for that. So I could see all these great founders and entrepreneurs that are trying to solve big things, and when you look at the data, it looks great, but I can't invest in them. I have to say no. And that was unfortunate. So then I thought, well, this is probably the same company. Someone should build a company that actually builds this data platform that we already know works, give it to founders, and then connect that to a new type of funding product that can finance many more founders if the data is there. And then I felt, if I want to do this, I really need that funding partners, the financing partners to build this, because if I build it only as a analytics platform, there are so many, so that won't work. So we have to connect it to the money side so it becomes significant, really important. And that's when when we met Axel and also Oliver, the third co-founder. And you guys had the same idea from the other side, and together we were like dating for some months, and then we got married. And then we created the company. That's how it started, right?
No, but awesome. Like there are several, how would you say, nodes or points. So you experience in startups, consulting, Nordea, McKinsey, Spotify, analytics. So if we go into that, what kind of is the niche for ArK, for example? Is it like, how would you define it? Is it something which disrupts the market on analytics? Or is it a new way of funding? Or where does it reside in the entire funding ecosystem? Yeah.
I think we were trying to build a platform for growth, is what we talk about, which is trying to build everything that founders need to grow their companies. And we know that these two tools that we're talking about here are really needed. It's both the analytics side that helps the founders and the team to optimize their growth, know when they need to raise money, and avoid making mistakes that will cost them a lot of money, and avoid that early on. And the other side is also the financing side, because we see this gap that there is in the market, which we kind of enable with this data-driven approach. So it's really both of those two things that we try to fill.
And I think your question is pretty spot on, because it's really where those two axes meet. I mean, there are tons of really good specialty sort of debt and finance organizations, and there are good analytics tools, but we don't see people really doing sort of data-driven funding of any kind. So it's still, ultimately sort of gut feeling and all the biases that come with that, and that's really our broader mission, sort of data-driven investment decisions.
And you started with by kind of relating your Nordea experience. And if we kind of zoom out from it and talk about the general banking sector, which is very traditional, it has to be traditional because there are several sectors that banks work with. How are you positioned vis-a-vis banks, for example? Not a particular bank. So there are several banks, like SEB is there, Nordea is there, Swedbank is there, and then there are international banks. We have seen even Silicon Valley Bank, which kind of, So, which said that it was a startups bank. So where do you think you are vis-a-vis banks, and where is it that banks falter when they have startups as their customers?
Yeah. I think a bank is fundamentally a vehicle for capital allocation, right? It's taking our savings and pension savings and channeling them towards investments. That comes with an inherently sort of very low risk tolerance, because you don't want to lose your pension because someone makes the wrong investment decision. So banks have become really good at taking low risk decisions, and in doing that, they've also become very narrow in what they do. So there's a very particular model, which is you want sort of strong majority owners, you want sort of a history of profitability, looking at sort of audited accounts, and you want physical assets on a balance sheet. And if you have all of those, it's a fantastic product. It's been really good for financing real estate, blue chip corporates. But then the problem becomes, if you want to do something more innovative that strays away from that mold, it becomes very sort of expensive and risky from the bank's perspective. So I think anything where they have to be a bit more precise, it becomes a bit hard. So essentially, like, if you can get something that's sort of financing that's long enough and large enough to meet your needs from a bank, it's typically very, very cheap. But that's a big if. And I think we're really about sort of being able to thread that needle a lot more and give companies what they need.
Okay. Then going back to your analytics side, because you mentioned that banks look at companies or businesses in a particular way, and then it's a box which you need to fit in, and then you get financing from box. But if you are somewhere outside that box, you will not fit in that universe. It doesn't matter which bank this is. What's your box? Like, how is your box different?
I don't like being in boxes. I'm outside the box.
Okay. How is it different when it comes to ArK Kapital? How is your decision making or the indicators, your metrics you look at, how are they different? Or how do you look at startups?
I think the difference is in the depth. So the platform that we have built is doing what we know that the fast-growing tech companies are doing, which is connect all your different platforms that you use to run your business. Like if you use Stripe or Klarna for payments, you connect that. If you use several marketing platforms for your marketing, you connect that. If you use something to track the usage of your users on the platform, you connect that. Whatever accounting system, you connect that too. And that's already proven that connecting all of that into one place on the raw level, so you get every transaction, every click in one place, and then you build your forecast from there. That you will get much better accuracy in your forecasting, you have much more granularity and are able to iterate faster in small micro experiments and things like that. So that's what we do with this platform, and we give that then that capability to many more founders. So that's the difference, because if you don't have this platform, it will take you time to build it, and this platform helps you to get there faster. And that's also the secret sauce for what expanding is my way of looking at this box for a bank. Because when we have this detailed view, we have much more insights into the future, more insights into how robust is this growth actually, because we can see down in much more granularity how the business has been in the past, and thus also be able to forecast this much better into the future. So that means that we can expand this box and still redefine risk in another way. So imagine if you're going to lend someone money and you can see much clearer, like an X-ray of this company in a much more detailed way. Of course, you're going to be able to lend to more types of companies. And also, if you know that you will also stay connected to this platform throughout the duration of your loan, you will be able to act every single day if something starts to change direction, way before it's too late. So of course, that's going to redefine how a bank will look at risk. So expanding the universe of what you can lend to.
Very interesting point, because with banks, there is a kind of so there's a gatekeeping. So you go ask for loan, then you're given a loan, and you are on the other side. And then something happens in 5 years. Either you are going up or you're going down, so there's a recall of loan or whatever. How does it work with do the founders need to be actively engaged with you during this process in the coming years when they take over support from you? How active is the work on the founder side or the company side in reporting or however, if we can go into that platform, and then we can go a little bit on other questions as well.
Yeah. Should I?
No, I think thanks to them being connected, it's very low touch on the sort of push side from the founders. I mean, since we can see what's happening in the systems, we get the reporting automatically. Okay. And I think the most important thing is we get it way before something goes amiss. Like with a bank, you send in your report every quarter, every year, and then the bank will say, I don't like this, and then it's too late to change. For us, the whole idea is that we want the system to be the way we measure the loan is how you measure your business day to day. Okay. So we want to succeed, you want to succeed in your business, and we're looking at the same metrics. So we're talking the same language. That said, I mean, being in the ecosystem in quite a few countries now and knowing a lot of the investor community, we do work a lot with our portfolio companies, but that's more to sort of help them when there's pull from them.
Okay. But the founders and the teams, they also use this platform to grow their business on their own, on a standalone basis, so they get the help to use the platform to understand how their growth is going, to see trends that are starting to change and act on that anyway. So we work with our platform with the founders in a way all the time, every day.
So it's much more than a loan management platform. It's more like a business management and an insight or predictive insights.
Yeah, we have several hundreds of customers that use the platform to optimize their growth today.
Okay.
And we have only financed some of them, but not all. So the growth of the platform is really taking off now with founders using it regardless of if they need funding from us or not.
Okay.
So we have more and more founders that actually use this for their growth and also their own fundraising outside of the platform. So they invite investors to the platform who also really like that they get a third-party view of the company.
And then because there are other deal management platforms as well, like if you go through crowdfunding, they will have their own deal management platforms, but then there are angel investment management platforms. How do you position against those entities in the market? Like Dealum is a platform, so is your platform more positioned towards business management or deal management or round management?
It's 100% first focused on the founders to help them to grow their business.
Okay.
So that's the primary focus. That's what we build it for. That's why we build out all the features to really help that thing. So people love the way that they can use forecasting and try out what happens if I increase marketing, what happens if a competitor starts to push my churn down, what happens if I increase my OPEX, to help them to guide them in growing their companies as fast as they can. And then secondly, we use that for our own lending decisions too, which means that we also build in things to automatically create scoring, for example. So we have done all the analysis that we know are really important to assess the fundamentals of your growth machine. We do that. That is being run every day, presented to us, but also to the founders in the same way. So they use the same tool as we do. So from that perspective, I don't know the other platforms, but that's the focus of this.
Okay, great. At what stage are founders ready to come to your side? And this question is maybe two parts. At what stage are they ready to maybe come into your platform? And at what stage are they ready to raise capital from you? Yeah.
Very good question. I think it's important that it is really two sides. I guess what you've seen and what we see is we also want to democratize the access to data. Like the people that get access to ways of looking at their data and building data-driven companies tend to succeed a lot more. So there's really no sort of too early to connect to the platform. The second you have data sources to connect, you should connect. So it helps you make better decisions. It also helps you interact with us and us to see when you're ready. I guess sums it up pretty well on the platform. In terms of lending, we are a bit different from an equity investor. I just was talking about this earlier. That's sort of the most painful part of my job is all these fantastic entrepreneurs with sort of pure ideas. That's the sort of risk reward on lending is a bit different. Like for that you probably need equity. When we came in is when you start seeing sort of a predictable side of your business, something that you can see you can repeat. You're probably pretty far from profitability. We can see you can monetize users in a certain way. You're starting to generate traffic, some revenue. That's when it's really sort of good to start talking to us. Okay. And then we'll typically, when you have a few sort of hundreds of thousands of euro ARR, is typically when we can lend to you. But we love to have early discussions because a big part of our business model is we think you can build more efficient startups if you think around capital allocation too early. Too many companies are built on having to raise equity continuously. So we love to talk through how you can build your business model with us, and then we can start lending from a few €100,000.
Okay. Going to the analytics side, like you said that when a startup is ready to enter your analytics side or the platform side as soon as they can show something, like what are the minimum indicators they need to need to have on ground for them to get access or get value from your platform?
So if you use any of the platforms that we can support, you can connect immediately. And what then will happen is that if you have no traction, no paying customers, nothing, it will be very hard to do any forecasting of that. You will see some data points, but that you won't get much value. But as soon as you have 20, 30, 50 or more paying customers, it will immediately start to try to forecast that. And if they have a predictable pattern, repeatable pattern, it will be quite good at forecast that for you. So as soon as you have that, the platform becomes valuable for you. And then you will get help to understand and see trends in how well are you at acquiring new customers, what are the trends in that efficiency, how well are they retaining, and how well are you monetizing them, and all the way to actually try to understand your own cash forecast, which is the key of every founder that builds a company, actually. And this we've seen has it's super helpful, of course, for early stage, but actually also very helpful and something that is often missed for later stage founders too, that they kind of miss this thing about planning ahead of your cash liquidity forecast, and then all of a sudden realize that shit, my money is gonna run out, or rely too much on that I will secure money later down the line. Then when they get there, it's too hard. So what we want to build into the platform here is the more other mentality to what we call growth control, to help you to visualize and see, do I have control of my growth? Should I invest? Can I invest more in my growth, or do I need to hold back to avoid falling too fast into the negative numbers on my cash?
Got it. And then, how much capital do you have in a particular time frame to deploy, and how is it in Nordics? Is your core market Nordics, Sweden, Europe? So if you can go there a little bit about your plans.
I mean, we started out with a very particular type of loan. We went to market with saying we could lend sort of 1 to 10 million euros to startups. And then we were limited by sort of raises we did with different funding partners.
Okay.
What we're really trying to create now is, as Henrik alluded to, sort of a funding platform where we have multiple funding sources, which helps us slice sort of loans and risks more in a particular way. So I think we've publicly stated that we can do 400 million euros, but with the sources we have now, it's not really limited anymore. So sort of as much as we think that the ecosystems can manage, we can lend basically.
Okay.
And we're currently doing it in the Nordics and Germany, and getting ready to launch in the UK very soon.
Interesting ecosystems. Yeah. And usually I ask these questions from venture funds, like, what's the minimum do you have a minimum ticket size below which you don't go, and is there a max ticket size? Like, I'm just trying to find the range where you operate.
Yeah, I mean, as I said, we're working on that because we do see a lot of funding needs also on smaller tickets. Right now, I say we'd struggle to do below 500,000 euros.
Okay.
And then roughly around 10 million on the max size.
That's a typical, I think, a good accelerator exit company, which is kind of raising their first VC round. So, and then that brings me into like when startups are raising, let's say let's make it SEK, like 5 million to 10 million SEK or 15 million SEK. How does the typical round construction look like? Do you go in alone, or with banks, or with angels? How does that look for the first time startup?
I think this sets us apart a lot from other people doing financing. We're sort of very agnostic around investment stages. So we're really looking for sort of, can the company comfortably manage this amount of loans? So that means that we have a lot of companies that have done lending instead of doing their next round.
Okay.
We also see examples where they do it in the same time. So that can range from 20% lending to 80%. And then what we're increasingly sort of, a big part of our vision is a certain part of any business model will always be quite risky and require equity. But there will be other parts that are more sort of very predictable, say customer acquisition with known payback times, or you might have a hardware component that pays back really fast. So increasingly we want to see everything that's predictable being financed by that. And then when you want to take sort of a new direction or new way of going, you bring in equity investors. I mean, equity investors are very good as well. They're good advice, can open up a good door. So we like the combo, but we can go at it alone as well.
Okay. I was meeting some of the founders who have joined in today. Like there are some from health tech side, deep tech, and maybe platforms in, let's say platforms, for example. What kind of startups or verticals are important for you, or where you think your model works best?
I think, I just go first. I think in the beginning, we thought we were going to build out like lots of different models for different verticals.
Okay.
I was envisioning that we will build like 15 different types of models for different verticals. But when we started to build it out, we learned that actually when you go one level below it and you go like in the fundamental parts of your business, you actually realize that it's actually the same. So every company, you really want to understand how good are they and what's the cost associated with bringing in new customers, right? And how good are they to retain them and monetize them? And what's the contribution from that engine to cover the rest of your OpEx costs? So we actually started to see that we don't need to have specific vertical models. We actually have one universal model for every business. And then what we then do is that means that we can understand many more businesses and the nuances of them much better, and we can leverage the forecasting ability from all of them to make the total forecast smarter. And then we obviously also build like metrics that are or benchmark numbers that are known in different verticals, like B2B metrics and stuff. We can extract that too. But the fundamental model we realized is actually the same. It doesn't really matter. So the businesses that fits us are the ones that you have repeatable business, and the more data, the better. So the more volume, the better. And that's natural, right? Because the more data points you have, the more statistical significance you get. So that's kind of how it works.
Awesome. We can open the house for any questions that our participants have. So let us know.
One there.
Can we say that you are a good substitute for Series A?
If the question was if we're a good substitute for Series A. And I would say yes, for a large part of companies, say 50% of companies out there, probably yes. They are raising money for quite predictive business models. There are cases where we wouldn't be. Say that you're commercializing a new sort of pharma invention or a new piece of technology. That will be hard for us to forecast in the type of data that we can use, and also as sort of financiers. But often a good substitute or complement, yes.
So no acceleration at all?
You mean sort of companies pre-seed
or just after seed?
I mean we do a lot of. I mean in the smaller tickets we do a lot of seed and beyond.
Okay.
And I think to Henrik's point, the second you have something that's measurable, be that sort of early customers or engagement data, we do think the platform is really helpful. We're also seeing some early use cases. We have one company that we're probably going to lend to now as well. They connected, and their sort of growth statistics on their early users was unbelievable. And to them, it was actually unbelievable. So it was helpful because any startup can show you a pitch deck where you grow really fast. But for them, it was pretty valuable to have something that was totally third party, unfungible. So they actually sent that around to their seed investors and used that for their round as well.
Can you say what was that data point?
That sounded the unbelievable parts. I think. Right. I think the sum of the analysis and the scoring was really, really good, meaning that all the fundamental signals of their growth, how fast they were acquiring customers and to what cost, and the retention rates of those, the trends of those, and how they had demonstrated that in several markets. So there is a lot of underlying signals that you look for that together forms the score of your growth performance, and that scored very high. So the numbers in the actual scoring was high, but that also meant that the forecasting of all those metrics looked really, really impressive, which was a very good sign. And for them, was that an A or a C, or I don't even know. We kind of also start to blur out those like letters, I think, because it's not so much about the letters for us, right? We want to figure out if you have proven yourself enough so that you can grow faster on your own or with funding, and that's what we want to figure out. And that's usually like, do you have predictable growth or not? That's the basic question that we try to answer.
I think.
One last nitty-gritty. What is their interest rate we're talking about?
Yeah. No, good question. So speaking of banks, we tend to be a bit more expensive than banks. We will price from say 10 to 15%. That obviously is sort of a lot of money that ultimately is paid to cover the risk. but our key differentiator is we also give out very long loans. So our loans are typically 6 years, and you only start paying back the actual loan when we think you're going to be profitable, so in, say, 2 years. And that means that even though interest ends up being higher, your actual free cash flow is typically a lot higher when you need the money before you're either profitable or do that big now letterless round.
Letterless round.
Okay.
Yeah, I have 2 questions. Founder of Abelian Investors. We're an algo company and more like the pharma case you mentioned, where we come out of 11 years of R&D, and we have highly unpredictable growth, but we have a lot of substantial value. How would do you get access to all of your growth metrics, and how would your growth metrics apply to those deep tech companies coming out of R&D, and when they hit one customer, they hit it big?
On the analytics platform, the center is really around customers. So if you only have one customer, it's going to find it very hard. So that's the unfortunate answer, I think, for now, if that's how it works. But I'm not exactly into the details of your specific case, because a lot of times you actually find that you can model it differently, and that it could work anyway.
That would be sort of the case for battery technology, pharma, or any type of company.
Yeah, so it could be that if you have other types of units that you can find volumes in, for example, hardware units that are not customers, that could work still. But that would be a tweak that we would do, because the first part of the model is really centered around customers. But I think what we have found is that the model is really attractive, the way to monitor it and grow it using this approach, and also the way to fund it. And what we have found is that this attracts many more companies to it that want to join and want to use it and want to fund their businesses, and that this model would apply also, if you tweak it a bit more, to other cases like this. And I think that's what we're going to add on later down the line too. And that's also part of why we want to grow as fast as we can, because then we can see more of those cases, so we can get them on board and build products around it, both on the data side and on the funding side.
The other question was that, do you get access to your platform where you can see how you look at things before you become a customer, or is that once you lend to that company only? Or can founders go in there and sort of see how you value things and look at things?
No, so the way it works is that you go into the platform, you connect the platforms that you use, and then you see your own company and the forecast and metrics for yourself. And then if you want, you can request a loan from that or not.
Just want to build a little bit more on the sort of your first question, because it's really important for us, especially sort of basically all the industries you're mentioning are the ones that sort of help us all forward. And it's like clean tech is it's a painful one for us, because we're very set up. We can actually lend cheaper if it's sort of validated clean tech, and it's a big sort of part of our mission to help the whole transition. But they're also very hard cases. Like, we see tons of really good entrepreneurs that are building, factories that will do everything from carbon suction to just more efficient production. Those actual factories are hard for us to finance, but that's where we've had some success in these sort of early discussions. Typically, you'll need X million to build a factory, but will also be, once it's built, be quite sort of predictable, but also sort of capital consuming to roll out. So we have a lot of cases where we've shown, okay, we're going to be able to finance this part of your business, and having that sort of committed and understood then helps raise the money for the initial investment. So we love to have those discussions early, even though we can't do as much as we wish.
Okay. Yes.
if you start with one big customer that have a lot of subsidiaries or divisions, could each division or subsidiary be one customer by itself in your system?
Right. Good question. You're trying to hack the system. And I think it comes down to like how it actually works. If the work that you do is trying to like get next division to join you, and there is like a big volume of such divisions, then it might work. But usually it works in the way that the work that you do is to try to attract another customer, another logo to the platform, and that's where your big pool of next customers could come from, and that's what you build your business model on. So usually that's the conclusion, so that it actually only counts as one, even though that one customer will grow with you over time, which is in itself a really good thing that you want to achieve. But for the platform to forecast it well, and also for us to lend to the business case, you would want to see more logos on the platform and measure and look at how efficient you are at getting more logos to the platform.
Okay. Do we have more questions? Yes. Yeah.
I usually speak loud. I don't think I need a mic. That's fine. Can you help companies across the globe? And also if you have a company group with multiple entities in different countries?
Yeah, so on the analytics platform, we're open for basically anyone. Then I guess we have to build some local connectors to help in sort of new continents. On the lending side, we're still bound.
Sorry, we're focusing on those 4 markets though.
True.
So far, but technically yes.
And on the lending side, so we're working on expanding. For now, it's sort of headquarters in the Nordic countries and Germany. But as I said, working on expanding to sort of UK pretty short term and US slightly longer term. We have tons of companies that have varied sort of domiciles and businesses in different countries.
Since the event is being recorded, I request that you ask your question to the microphone, please. Thank you.
Do you drink your own medicine? In the sense, for your analytics platform, do you use your analytics tool to monitor your growth, your business?
Yeah, that's a great question and a very common question. And of course, the answer is yes. But with the caveat that the platform and ourselves are also built, as we mentioned, for like when you have come far enough so that you can show and demonstrate predictable growth, which meant that when we started 2 years ago, we were too early for our own platform, and also the platform didn't exist. But now we're getting into the point where we can use it for ourselves, definitely.
Before I have a question, like based on what's coming in, because you said you started around in the same period where we have seen this financial turmoil kind of brew and kind of go. So how has this affected your operations as a company, and what do you see in 6 months, 12 months, 18 months going forward?
It's been a chaotic time for sure, to say the least. And we started this in the very high peak of the tech valuation bubble before the crash. And we thought when we started that our big battle will be here to fight against the common positioning of how people look at debt in general. Because I was a VC myself before, I can really admit that when I looked at a company as a VC and saw that they're using debt to fund their growth, I was like, don't even go there. That means that they haven't found any other investors that could back them. So it was seen as for us, a very negative thing. And I really thought, and we thought that this is what we need to evangelize a lot about. Like this is the new way to grow your company using debt as a new instrument based on our data. But then the whole crash changed this completely for the better for us, actually, when you think about it, because now you can't anymore raise money with a WhatsApp message to an investor. It's very hard to raise money nowadays, and also the investors these days, they also start to talk about they want to see a path to profitability. And if they start to talk about that, well, then the case for us becomes much easier, right? Because if you have a path to profitability, well, that means that you have proven your business already. That's exactly why our case works much better. Because if you have already proven it, why do you have to give away 20% of your company? Then of course you should be able to lend at it. So our discussion became much easier, and people were much more open now to talk about debt and this new way of growing companies than before. So it's actually a really good thing for us.
Very interesting. And what do you think is the core motivator for a startup to turn to your side? Is it that they are struggling with the VCs, or is it that they don't want to give out an equity at an early stage? What is the primary driver right now that you see?
I think it depends a lot on markets, but we're seeing a sort of growing sort of maturity and understanding of that. So it went from, as Henrik said, being sort of you couldn't find another capital source.
Okay.
Now I think you're a lot more aligned with equity and debt investors. I think people realize, okay, it's good to avoid dilution regardless of the term sheets I get. So it's good to bring that across. But people are also increasingly thinking sort of smart around their whole sort of capital table. Like they want multiple options. They want to sort of slice the growth needs of their company. Like, okay, this is going to be equity. This is going to be predictable. This is where I want that. And that happens a lot more sort of in our early discussions with UK companies. They're more used to that than we are in Sweden. Okay. Same thing in Denmark, surprisingly, whereas Sweden and Germany, we're probably still in the sort of no dilution bucket.
Okay. Many startups, when I was kind of meeting startups when they were coming in and the audience here, you've been in this industry for quite some time from many different hats and angles. So if you're an early stage startups, what would be your advice to that startup in raising funding? So maybe pre-seed and seed stage. What kind of needs to be in the current funding climate, be the focus of the kind of North Star for the founder or the founding team?
I really think so much about thinking about your metric, thinking about your business model already from the start, and use that to prioritize what you build. Because if you use that and try to focus what you do in the early stage on building what you need to prove that you can actually get that business model to work. If you do that well, you will spend all your energy on the right things in the beginning so that you, as fast as you can get to the point where you can prove for yourself and for other investors potentially that this is going to work from a business model perspective. If you wait too long with that, you're going to waste, like it's going to require more energy and money from you or your partners to get to that point. So I think that's really what I would want to focus on if I gave it that advice, especially in this world where you don't have the option anymore to raise money without your metrics in place. So that's my advice.
Yeah, that's a very interesting point. You can't raise money without the metrics in place. Okay.
We have a question here.
Yep, please.
Yeah, thank you very much. So maybe I missed a little bit of the discussion, but this platform, I want to see the relationship between the platform and the investments. Is it a prerequisite to get into the platform, and then you do the forecasting and prediction on that platform, and then you go to the investment stage, or how does that work?
I mean, yes, for us to make an investment, you need to be on the platform, and it's a big part of our investment process. Not as big as with some other fintech lenders. We also do have actual people that want to talk to you and understand it.
Actual people.
And it's an important distinguisher.
Yeah.
But it's that said, I mean, we have companies and founders that approach us and just want to sit down and talk through sort of lending potential options before connecting. But honestly, we don't see sort of any reason not to connect straight away for insights and then have the discussion come that way.
I think that was more common like last year when we didn't have the platform live. So obviously that was different then.
Okay. Yes.
One more question. Do you see any difference in different kind of customers, like if you sell directly to end users, if you go through distributors, because that could reflect how to grow.
Yeah, definitely. So I think you can have lots of different channels on how to acquire your customers. It's going to be direct or indirect through other partners. And I think, no matter how you do it, they're going to end up as customers. And then what we will then look at is how efficient that is. So it actually doesn't really matter. And I think all means are good as long as they're net good for, it works for your business model.
Yeah, I had one more question there on what Henrik said with this time period we've been in with changing valuations across the spectrum. How would you look at fintech and sort of all the assets if you were lending, for example, to a bank who has a lot of uncertain metrics of what things are worth? How would that fit into your model and system?
It's a difficult question. In general, I'd say that sets us a bit apart from especially bank lenders in that we don't lean too much on the sort of asset side of a borrower. So there will be, basically, if you have valuable stuff, if you're sitting on sort of financial assets or properties, there are other firms that are very good at assessing the values of those and lending a percentage. I think our edge is really in predicting cash flows. So we don't get too deep into those questions, to be honest.
All right. Okay.
It's for the recording.
Yeah, it's recorded and then it's played back on Startup Grind Global.
Hi. So my question is maybe basic. You said you want to integrate all the products or apps that startups are using, but there may be some startups they're doing everything in Excel or most of the things. Do you still able to manage that kind of data and give a decent forecasting or anything on that?
So if you're doing everything in Excel, you mean?
Yeah, exactly. Excel or any other.
Right. Well, if you're building a business and only use Excel, I think you're probably also using some kind of a payment method to get payments from your customers. You probably not use Excel for that, maybe. Yeah. And you're also probably using a marketing platform to do marketing of your business, also not using Excel, maybe. So if you do that, then you have two platforms that you can connect to and that we can connect to and then help you to see those metrics. I think the Excel part, what we see is sometimes the companies, they are not using yet an accounting system, but they actually do the accounting in Excel. And then that becomes a bit problematic because then we cannot connect to an Excel spreadsheet. And then I would really advise to, if you want to scale this, it's not going to scale with doing the accounting in Excel. So then you would need to go to one of the platforms to help yourself, but also to connect to other partners like us to get it funded.
Like another thing is about the CRM. CRM, you can have it on Excel, right? Like you don't have to go to HubSpot.
Yeah, exactly. So actually we don't require you to connect your CRM systems, so that wouldn't be a problem.
All right. I think that was the questions. I don't see any more hand here, but a big thanks to ArK Kapital for tonight's talk. As I said, it's after 3 years we are meeting, so we'll do this more often. Next month we'll have Luminar Ventures coming in. Jacob and Magnus will be here, and after that this is Ampli Ventures. So we'll have these as a monthly feature. But for today and for our first talk, a big thanks to you.
Thank you.